Expert-level intelligence briefing. Deconstructing the shadow financial state for narrative supremacy. E. The architecture of systemic vulnerability. Defining the financial shadow. Stability of the global financial system is conventionally measured by the health and regulation of its visible components: commercial banks, central banks, and public financial institutions. However, an exhaustive analysis of systemic risk reveals that the true locus of leverage, instability, one, unlike traditional regulated depository institutions, shadow banks, or non-bank financial companies, NBFCs operate with little to no oversight from regulators. To this crucial distinction, shields key players such as hedge funds, private equity funds, and certain investment banks from the stringent risk, liquidity, and capital restrictions applied to commercial banks. To the Financial Stability Board, FSB, an international financial authority, defines this system by outlining its credit intermediation functions that fall outside the regulatory framework. The systemic scale of this unregulated sector renders the traditional focus on banking oversight profoundly incomplete. Despite a minor decrease in 2022, largely attributed to the impact of rising interest rates on asset valuations, the global NBFI sector's total financial assets stood at $217.9 trillion. For this represented 47.2% of total global financial assets, demonstrating that nearly half of the world's capital velocity exists outside the principal regulatory net. Furthermore, within major jurisdictions monitored by S&P Global, shadow banking held an estimated $63 trillion in financial assets at the end of 2022, a figure equivalent to 78% of global GDP. 5. This magnitude underscores a profound structural transformation in global finance. The paradox inherent in this structure is that regulatory bodies, including the FSB and G20, actively define and monitor this shadow system, explicitly recognizing the risks it poses to global financial stability. Yet, the system's growth has been rapid and continuous, the sector only growing less than the regulated banking sector during the extraordinary central bank interventions of the COVID-19 shock in 2020.7. This persistent expansion, particularly noted in the euro area where NBFs account for a larger share of GDP than in the United States, suggests that powerful entities are permitted to dictate the terms of their exclusion. The global financial system's core safety net is secured by state guarantees and central bank facilities. These functions include maturity, transformation, where short-term borrowed funds are used to purchase longer-term, less liquid assets; liquidity transformation, where cash-like liabilities are converted into harder-to-sell investments; and leverage, the use of borrowed money to maximize potential returns. To these core activities are inherently volatile. Crucial difference distinguishes shadow banks from their regulated counterparts: the lack of access to public liquidity sources, such as the Federal Reserve's discount window, or public insurance, such as the FDIC. 9. Instead, shadow banks rely on private backstops, like contingent lines of credit or tail risk insurance, often provided by commercial banks or insurance companies. 10. The subprime mortgage crisis of 2007-2008 provided a definitive case study in the catastrophic failure of this reliance. The meltdown of the U.S. asset-backed commercial paper ABCP market began when conduits and structured investment vehicles SIVs, which were heavily invested in subprime mortgage-backed securities MBS, faced massive investor flight. This demonstrated that their private liquidity support was insufficient, triggering widespread panic and revealing the lack of necessary backstops. 11. The operational history of shadow banking confirms a core financial conspiracy. The profitability of the sector relies on generating immediate cheaper credit during economic booms, with the explicit systemic consequence of generating more severe crises and more expensive intermediation during downturns. 10. This volatility is not an accident. It is the mechanism by which vast wealth is extracted, Regulatory arbitrage, the engineered migration of risk post-2008. Post-crisis reforms, particularly the tightening of capital requirements and liquidity reserves for banks, led to an unintended consequence. The migration of traditional banking activities to NBF is that we're subject to looser regulatory regimes. 3. This process, known as regulatory arbitrage, has been actively facilitated by the regulated sector. Commercial banks, seeking to maintain profitable client relationships and fee income while avoiding burdensome capital requirements, actively cooperate with NBF is to transfer risks. The myth of safety. Public backstops for private gain. The shadow banking system relies on an operational fiction, that it is entirely private and therefore insulated from and independent of the state safety net. This fiction was violently shattered in the 2008 crisis and again during the market distress of 2020. Money market funds, which are critical components of the NBFI structure, experienced runs multiple times, including after the collapse of Lehman Brothers in 2008 and during the liquidity crunch. Even though they were not subjected to the regulatory costs associated with being formally insured. 15. The market recognized this implicit guarantee, evidenced by the fact that capital has continued to flow heavily from regulated bank deposits to MMFs, with MMFs increasing their assets by $1.10. $1 trillion between March 2022 and November 2023, while bank deposits decreased by $708 billion during the same period. 3. This historical pattern means that the private status of shadow banking is a legal facade. Elite facilitation. The role of hedge funds and private equity and systemic leverage within the NBFI ecosystem. Specific high-leverage entities function as primary debt transmission mechanisms. Hedge funds and private equity funds are explicitly categorized as financial intermediaries that operate outside the constraints of traditional regulation. The FSB highlights that leverage within the NBFI sector can be an important amplifier of stress and creates risks to financial stability, particularly through interlinkages with systemically important financial institutions. 13. Private equity in particular utilizes the leveraged buyout (LBO) model, which relies on acquiring companies using a relatively large portion of outside debt financing. 16. While the stated purpose of private equity is often to optimize corporate governance. 17. The operational consequence is the imposition of massive debt loads onto real economy enterprises. The shadow banking system provides the necessary opaque and often unregulated funding for these transactions. The true function of these powerful NBF is not just financial engineering. It is the strategic weaponization of debt to gain leveraged control over significant portions of the real economy. This confirms a core financial conspiracy. The system ensures corporate dominance is achieved through the calculated application of immense, often opaque debt. Hidden history and illicit capital flows, the antiquity of control. To fully appreciate the scope of the modern financial conspiracy, one must acknowledge that the phenomenon of a parallel the global velocity of capital remains partially ungovernable. validating the conspiracy narrative that governments have never truly achieved a monopoly on global wealth movement. 3. The global creditor conspiracy, wealth dynasties, and the narrative of control. The transition from ancient trade-based systems of value transfer to modern, debt-driven financial complexity is illuminated by the history of dynastic wealth. The Rothschild family, an Ashkenazi Jewish noble banking family, rose to global prominence in the late 18th century by establishing an international banking network across major European capitals, Frankfurt, London, Vienna, and Naples. 21. By the 19th century, this family possessed the largest private fortune in the world. 21. Their mastery of debt and cross-border credit predates and operated in parallel with the modern concept of state-sponsored central banking, proving that immense private financial power can span sovereign boundaries. Due to their historical dominance, the Rothschilds have become a historical archetype frequently cited by conspiracy theorists as a prime example of global elites, using their money to control and manipulate global financial institutions. 2. To the critical connection for the conspiracy narrative is that the rise of state central banks did not eliminate private financial control. It simply drove it underground. The modern shadow banking system, with its massive, leveraged, and international scope, functions as the current, technologically advanced successor to these older, privately controlled financial networks. The hidden truth is that the same ambition to control global capital flows outside of state oversight is now realized through the NBFI and its hundreds of trillions in opaque assets. Shadow Banking 2.0. Decentralized finance is the new frontier of risk. The perpetual challenge of regulation is its inability to keep pace with financial innovation. As global authorities increase scrutiny on traditional NBFI hedge funds, MMFS, and derivatives anew, technologically sophisticated regulatory escape hatch has emerged. Decentralized finance DeFi. This segment represents the most advanced evolution of the shadow financial state, the fintech paradox. Leveraging anonymity for unregulated intermediation, decentralized finance DeFi, which utilizes blockchain technology and smart contracts, is now being actively analyzed by institutions like the FSB and regulatory scholars as shadow banking 2.0. This characterization is justified because DeFi replicates core credit intermediation functions and systemic vulnerabilities. It's found in traditional shadow banking, but with added technological insulation from centralized oversight. DeFi platforms facilitate high degrees of leverage, sometimes offering up to 5x isolated margins, possess high structural interlinkages among participants, and suffer from issues relating to non-compliance with existing regulatory requirements or outright lack of regulation. 23. Furthermore, DeFi governance arrangements are often unclear, opaque, or easily manipulable, which exposes users to severe risks such as rug pulls and operational failures. In contrast to traditional finance TradFi, where government-mandated disclosure and consumer protections exist, users in DeFi assume all risks as a default. 2.3. The technological reality of DeFi presents the ultimate regulatory challenge to central banking secrecy and control. If regulatory pressure successfully constrains traditional NBFI activities, capital seeking the highest leverage and lowest oversight will migrate to DeFi. This migration institutionalizes regulatory arbitrage by providing a mechanism to perform bank-like functions, credit, intermediation, leverage, and maturity transformation while using anonymity and decentralized governance to legally resist all attempts at centralized cross-border oversight. 13. This reinforces the core conspiracy theory. Financial elites can perpetually engineer technological sanctuaries for untraceable capital. Title generation and compliance matrix, the deliverable. The titles below strategically fuse technical financial concepts like regulatory arbitrage and liquidity mismatch with high-stakes conspiracy language, secret exposed, forbidden, closing parenthesis, title generation and compliance. Matrix niche, money history plus debt plus central banking secrets plus conspiracy, hashtag YouTube, title 8 to 14 words. Conspiracy tone word count core niche. Integration 1 central banking secret. They bailed out the shadow financial state. 9 Central. Banking conspiracy, shadow banking to the $217 trillion. Debt loophole hidden from all regulators. 10 Global debt economic paradox conspiracy. Exposed, the ancient Hawala system controls global black money. 9 Money history conspiracy illicit flows for why does the Fed protect unregulated shadow banks?